Alphabet or Google just reported amazing first quarter 21 numbers. The stock popped about 3-4% the next day. I mean, look, revenue growth for a behemoth, a $1 trillion company growing 30% plus is quite impressive. I personally own some Alphabet in my portfolio. It's been about 3x for my personal journey. That said, it's relatively small, and I'm wondering if it's too late to buy more. It's a big question for me. And, as I look at it, it's like, yeah, 3x is great, but does this still have room to run? Could this become a 6x? Could this double from here, maybe even triple? And then broadly, a lot of people are worried about the broader investment climate. Will Jay Powell eventually have to raise rates? What will higher inflation have to do with the market? Is Google the type of safe stock to own regardless of investment horizon? As I discussed in this video, when I look at the risk reward, I personally think that Google's risk reward is pretty reasonable. So I think Google, relative to the broader market, is definitely, in my opinion, a safe stock. That's how I think about it. We'll talk more about that in terms of valuation, risk reward towards later on in the video. So let's go through each of these pieces in their first quarter numbers. And so, is it too late to buy more, especially when you see that the stock has done really well this past year? So, Wall Street has woken up to the idea that this is an exceptional company. Surprise, surprise, a nearly double in a year. But is it too late? Have we missed out on it? And so let's understand the different pieces that's actually driving their business. And you see, look, holy smokes, this is just such a huge company, 200 billion plus in revenue, it looks like, where in the first quarter alone, 55 billion in revenue, of which 80% plus was driven by ad revenue. So ad revenue across their various different properties and associations. So $44.7 billion in advertising revenue driven by Google Search, which was up 30%, YouTube up 50%, and network sites that use AdSense, which was up another 30%. So overall advertising up 32%. Pretty incredible to see 10 billion plus gain year over year in ad spend. You also have some pretty incredible growth as well in Google Other as well as Google Cloud, both putting up nearly 50% growth. We'll talk about each of those items in a minute as well as other bets. And so let's understand what's driving this incredible growth with ad growth. 10 billion plus improvement year over year, 30% plus growth. And I think there's a trifecta of what's going on, where one is YouTube is just this behemoth where advertisers, as they talk about in the conference call, are using YouTube now to reach the audience they can't find anywhere. And here, there's a key point they call out, which blows my mind. Remember, more 18 to 49-year-olds are actually watching YouTube than all linear TV combined. And you know what? That reflects that, viewers are finding quality content that hopefully resonates with what they're looking for, and it's a better value proposition than what they can find elsewhere. So this is it. YouTube is actively getting people's eyeballs, and hopefully this site's another example of something that's adding value to the YouTube watchers. And so an example of how YouTube revenue is growing dramatically is they've talked about direct response ads, which is a relatively new development over the last few years, where effectively it's been used with some brands like Jeep, where they tested this new direct response ad format where during the advertisement mid-video you can sort of get additional, it's almost like app within an app within YouTube, where you can sort of play around. Oh, do you want to test drive? Oh, do you want to try something? And doing this, having this sort of added functionality where you can directly press a button saying, yes, I am interested, resulted in completed leads multiplied by 13 times and an 84% lower cost per lead. So this is an incredible return on investment, this direct response ad. So YouTube, that's one of the key components of the trifecta. Then another aspect is Google Search. That's the the core product that many users have come to love as one of their first core products. And they just continue to add value to users every day. A lot of people have been sort of displaced with the COVID, economy setbacks. And look, now it's making it easier for companies to post jobs, for people to search for jobs, or about COVID, public service announcements, or even event bookings, where now they recently made it free for hotels and travel companies to list their booking links. So it's even easier. Oh, you want to go to the movies? Oh, you want to get a haircut? Oh, you want to schedule, going off to a diner. You can all do this, just looking in search. There's all this functionality. And then the key, I'd say the third component of this trifecta is Google Maps, where they are enabling retail. They're enabling omni-channel retail. Omni-channel meaning, e-commerce, in-person, pickup. It's all these different options where you can say, hey, and they call out Dick's Sporting Goods on their conference call saying, look, people would look this stuff up and they want to know what's near me, what does this have in-store shopping, is it curbside pickup? Oh, if I want to order it online for delivery, I could do that. I could call them up. I see their hours. So Google Maps is just becoming increasingly valuable for people, as they want to purchase things. And they called out that Dick's Sporting Goods e-commerce, I think, was up 100% year over year as they've partnered with using the various different YouTube properties. And so you look at this trifecta and it's YouTube builds the brand awareness. You start learning about a product, you search for it on Google, and then you find out how you can get it on Google Maps. And it's just this beautiful connection where, you build your brand. Customers quickly can find out about it either through YouTube or they end up searching for it, and then how do they ultimately buy it? And management thinks, look, this is just the beginning because commerce is 80% still offline. 80% of commerce is offline, 20% online. So this is a multi-decade tailwind as businesses realize, wait a second, I need to make sure I have my presence on Google Maps. I need to make sure I have all this functionality built out through Google Maps so people can make sure they can easily call or click on a website or they can order. So all this functionality being enabled. Oh, yeah, we already worked on our making sure we cover our ads. And then, oh, you know what? There's additional functionality of proving out our brand or maybe creating this direct response links in YouTube. Maybe that's something else. So I think this is a trifecta that can drive many years of growth ahead. And so, you look at that's the Google advertising, which is, 45 billion in revenue in the first quarter. So then what's this other line that's the only, other component that gets to Google services, and that's growing at 47%. So what is this at nearly $6.5 billion in the first quarter? And these are also fantastic business lines. You have Google Play, which is effectively the App Store for Android, where they get a 30% cut. This is a beautiful business model. This is a toll booth business model. Every time someone's, effectively paying another app, they're getting their cut to make sure, hey, this is not a bad app, not a bad apple in our App Store. Beautiful business model, incredibly high margins, great growth. And part of this is just people are spending more time online. We'll talk about that in a second. And then YouTube Premium. So this is the non-advertising revenue for YouTube where people are paying for subscriptions. I personally use YouTube Premium. I think it's fantastic. I wasn't paid or anything to do this plug, but as much as people enjoy doing the ads, I personally enjoy being able to just cruise right through videos without having to listen to an advertisement with music or with videos, all YouTube Premium for a reasonable price, and they have an even better family plan as well. So these are great businesses, and there's also hardware included in Google Other. They recently acquired Fitbit, and they also have the Pixel phone, which I can personally test as a great product. And this offers a lot of optionality if this were to work. If people were to start saying, wait a second, I can get a premium phone and all this cool different functionality that works well together, and maybe I can break that iOS ecosystem. That said, I don't think that's going to happen anytime soon with the numbers Apple's been putting up, but there is some optionality. So next up, you look at Google Cloud, which is the next key component. Keep in mind, all the profits so far that you're looking at are from Google services. So when we're thinking about valuing Google, oh, now Google wants to talk to me. Thinking of, looking at these different segments, you see that, the only profit is Google services. Everything else is a multi-billion-dollar investment that they're doing. Google Cloud is $1 billion investment in one quarter. Other Bets is over $1 billion in one quarter. So as I look at Google Cloud, I think it's a contender in the space. That said, they are relatively small compared to AWS, so Amazon's cloud offering, and Azure, which is Microsoft's, and they are putting up similar growth rates to their bigger brothers. So it does concern me that the growth rate isn't better, because if you're smaller, if you want to show that you're taking share, you need to be putting up a faster growth rate, especially if you're smaller. So, I would ding that a little bit, but, it is worth understanding when you're thinking about valuing this business, it is at you need to be thinking about what's their optimized margins longer term, because right now they're nowhere near the juicy margins that you see with Google services. Google services, their profit margins, range from, let's say, mid-30s to high 30s, maybe even in the 40s. So when we're valuing it, you'll see that as such. Most recent quarter was close to 38% for Google services. And then you look at Other Bets as well. Once again, optionality, meaning, something that can be like a lottery ticket that's not really priced in correctly. And, Waymo, it's currently rolled out in Phoenix, Arizona, where you can just, queue up Waymo One, that's the app, and you can get a driverless car, just come and pick you up. And they're doing hundreds of these a week. And now they're starting to test it in San Francisco. So I think, a lot of people think, oh, Tesla is the better play here. But if they can roll this out one market at a time, and effectively copy paste one city at a time, and it works, this could be a winner. This is a big optionality for them. And testing in San Francisco, that would be no small feat if they're successful. Right now it's with drivers in the car just to make sure nothing screws up. But if that means in a year or two from now you truly do have a robo-taxi in San Francisco, that would be mind-blowing. And then another example of their other bets is Calico, which is a life sciences company, which earlier in the quarter announced a partnership with AbbVie, where here it is, they're announcing like, look, they have a bunch of different drugs in the pipeline for phase 1 studies with the FDA, trying to tackle things like immuno-oncology, i.e. cancer-related immune system, tackling it, neurodegeneration, as well as age-related disease. So they have 20 different active programs, and this is another perfect example of optionality. If you're able to win, you're taking your machine learning with Calico and working with AbbVie that has plenty of experience launching new drugs, and you're able to say, hey, we successfully launched a cancer treatment that ultimately results in a market that's tens of billions of dollars, or neurodegeneration like Alzheimer's, or even age. If you're able to, what's the odds that Calico helps with something with extending life expectancy by 10 years? If you have something like that, what's the value of that? So that you have all this sort of hidden optionality when you're thinking about this company. So what about the valuation? What should we think about when we're considering all this? And first, like a quick plug just for those that are new to the channel. My name is Daniel. This is Unrivaled Investing. If you enjoy learning about the types of companies that can go up hundreds or thousands of percent over time, I call those potential multi-baggers. Make sure you subscribe. If you're already a subscriber, I do appreciate that thumbs up. And if you want to follow my personal journey as I'm looking for potential multi-baggers, go to unrivaledinvesting.com, building a like-minded community of investors that are eager to find these potential multi-baggers. Each month, I call out one potential multi-bagger, at least one. And at the first week of the month, I also give a full breakdown of my portfolio. You can see it all at unrivaledinvesting.com. And my firm belief is just finding one potential multi-bagger can change your life journey. So if you're interested in following my journey as I try to find these, go to unrivaledinvesting.com. Let's go back to Google, understanding what's the valuation and is this indeed a safe stock? And so, as I look at this, it's going to be a little trickier to forecast Google's numbers because COVID definitely does make things a little more volatile. Google posted a negative quarter in the second quarter, and a lot of people weren't expecting 30% plus growth in the first quarter. So what does management have to say around guidance? And so they're saying, look, we have a greater benefit in the second quarter from an easier comp, i.e. we were declining last year and we're not seeing any weakness now. So their growth rates are actually going to accelerate into the second quarter of 2021. And then beginning to lap stronger performance in the second half of the year, i.e. we showed better results in the second half of last year. So it's going to be our growth rate will decelerate presumably later on in 2021. In the first quarter, we continue to benefit from elevated consumer online activity, i.e. COVID's not over yet, so people are at home. If you've been vaccinated, it's much closer to being over for the most part. And broad-based strength in advertiser spend. Okay, so you have a strong economy and people still, sort of staying indoors, higher online activity. So, if you were to see online activity take a hit, or let's say the economic hit with advertiser spend, you could see weakness in the future, but not yet, not what they're seeing now. And they're saying it's too early to see how durable this consumer behavior will be as economies recover and restrictions on mobility are lifted. So it's a little hard to forecast, like, hey, does this growth, this incredible strength that they've posted in the first quarter continue? And so when I think about what a hypothetical valuation for Google looks like, I think it's important to try to take a conservative view. And so what I end up doing is annualizing their first quarter 21 numbers. So saying if you did 50 billion in revenue in the first quarter, well, let's annualize that, multiply it by 4, and now it's 200 billion. Now that's not perfect because usually you have some seasonality where fourth quarter is stronger, but there's going to be a lot of bumpiness with COVID. So let's just think about annualizing first quarter. This might be a little too conservative. And then if you just look at Google services, just looking at Google services, they did 130 billion in revenue in 2018, 151 billion in 2019, then 168 billion in 2020. So what's the range of growth in for 2021? And I'm putting a range of 15 to 25% for the year, which is effectively based on annualizing the first quarter numbers. Annualizing it would get to around like 205 billion, which would be between here. Then what's the optimized margins that you should think about valuing this at? Google services. This doesn't include Google Cloud or their other bets. We'll talk about that in a minute. So I once again assume margins of 35 to 40% over time. This past quarter was 38%. Maybe you're over earning. That said, I do suspect 30, high 30s, maybe even low 40s is the appropriate way to think about their long-term valuation. Slap on a 20% tax rate. That once again might be conservative just because historically they've been able to get taxes lower than this. So that gets a implied earnings multiple of, let's say, low 20s to 30 times for just Google services relative to Google Enterprise without thinking about any cash or equity investments. So then what's the growth rate in the years ahead? Because I always try to take a 5-year time frame. So I'm looking out 2021, then let's think about the following 4 years. And so annualized growth of 10% to 15%. You can ding it. You can say this is too conservative. You can say this is too aggressive. I mean, that's part of the reason why I show my assumptions. You can make your own assumptions. And then an N multiple of, let's say, 15 to 21 times. So that's what it would be valued at, hypothetically, in 5 years from now. This is a logical framework. Stock price can go way higher or way lower, but this is just thinking about Google services, and it shows that this segment alone, Google services, could be, based on these assumptions, a range of around $1.2 trillion in value to $2.5 trillion in value, which would represent about 50% upside to about 30% downside just for Google services. No credit for anything else, which we'll talk about in 1 second. So I like this risk-reward dynamic as I'm looking at it, making me feel good as a shareholder. Wish I owned more, especially I'm looking at a $1.6 trillion valuation and thinking, wow, on not too aggressive assumptions for the ensuing 5 years for low to high scenario. In my aggressive side or my high side, you can argue whether or not it's aggressive. I'm saying $2.5 trillion value just for Google services, in which case 50% upside. So that's interesting. That's over 5 years. So 50% upside over 5 years isn't super compelling. But then we need to factor in these other components, such as Google Cloud, other bets, and their equity and their stock positions and their cash. And when you factor in all these other things, and in my spreadsheet, which I can drop in the description of this video for users to consider, I showed the assumptions for Google Cloud. It's a little more aggressive based on their growth rates, slightly lower margins though, like 25 to 35% operating margins. And based on that, looking at all these different components, you're effectively saying, and the fact that there's a lot of cash building up. This is a company that's generating 50 billion plus in free cash flow a year, and they just announced a $50 billion buyback. Now, 50 billion, that sounds like a lot, but when you're looking at a $1.6 trillion company, it's actually just barely moving the needle. That said, it is effectively cash that's going to be accruing to shareholders, so you do need to factor that in when you're thinking about your analysis. And I'm effectively saying, look, in my downside case, you're effectively saying you're doing better than cash, and in your upside, your base to upside, you're getting either a teens to a low 20s percentage return annualized over 5 years. So this gets back to my opening question: is Google a safe stock? And I think relative to the broader market, relative to the indices, which some could definitely argue are in very expensive territory, I think Google actually represents a relatively safe stock. You see a lot of these high flyers with no profits and questionable business models, and here it is. You have a rock solid balance sheet, incredible free cash flow, and delivering services that people need. And so I look at this framework, and yes, of course, it go higher or lower, but I think this is a relatively safe stock for investors to consider, and I like the fact that management hopefully is starting to wake up that they need to start really doing buybacks, which in a worst case scenario does sort of provide support for the stock. If things turn awry, that assumes management actually does buy back stock. Historically they haven't really pulled the trigger in a way that I'd like. And this isn't the first company that I've actually called out as potential multi-bagger with a very reasonable risk reward. It seems like some of these big mega caps are actually more reasonably valued. I also called out Alibaba, so you can check out that video. And Journey subscribers. So, I personally own Alibaba. I personally own some Alphabet. And Journey subscribers, that want to follow, the potential multi-baggers I call out, if you go to the catalog of contents, which is in the description of this video, there's a tab for potential multi-bagger. So my April potential multi-bagger is a stock that I thought has 4x potential. So it's one of these things where, yeah, Google does have this nice upside, but I'm also looking for companies that I think could be a 4x over time, that has way more upside, and generally they're smaller companies because, it's harder to do 4x with a $1.6 trillion company. Let's be honest. But those are the types of things I'm looking for. And this is a journey. This isn't day trading or things like that. I'm looking for companies that I can sit and hold on to over time. If you can sit and hold on to things like Google, then you could be, you can have a good ride over time because you sit and you just let the compounding work for you. And, you make 2, 3x, 5x, 10x over time. And so I hope this video talking about Google, what I think, as a relatively safe stock in an otherwise arguably expensive environment. And thanks so much for watching. Thanks so much for subscribing if you are. And you're always welcome to ping me and leave a comment below about the next company that I should be looking at. Thanks so much for watching.